Good morning and welcome to this Monday, January 11th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. It does look like futures are lower. So after a really good week last week, looks like there'll be a little bit of profit taking at the open. We've seen it before. We'll see whether or not the selling continues or whether or not we get a rebound. The history of the market has been each time, seems like each time we get a little bit of pullback, we have buyers step right back in. But at some point, we'll go through a period where we get a little bit more consolidation. We are just about 1 week away from the end of the most bullish period of the year. Pointed that out back at the end of October 27th at the close through January 18th at the close. So that is next Monday's close. That is the most bullish period of the year historically, those 2 months and 20 days, 21 days, whatever it is. Historically, they've just been consistently strong. I think it's something like 59 of the last 70 years. The S&P 500 has finished higher at the end of that period than where it started. So that's only 11 out of 70 years where it's gone down. That's pretty strong indication or strong historical suggestion that the market was going to go higher, and it did. Of course, we do still have a week to go, so can't count on it just yet, but it does appear we'll be higher this year. After that, we tend to see a little bit of profit taking. And this is typical not just for January, but I also wrote an article recently talking about the history of the market heading into earnings season. So whether that's the end of December into the first few weeks of January, or whether it's the end of March into the first few weeks of April. Same goes for the end of June into early July, and then the end of September into early October. The market tends to perform better than its average, and in a few of those cases, much, much, much better than average, as the market anticipates the earnings reports coming out. And then the earnings reports come out, and that's when a lot of the fundamental investors jump in and don't understand why the market's going down. But a lot of it has already taken place. You got a lot of folks, big money, that has been bidding these shares up heading into their earnings reports. And so that's your buy on rumor, sell on news adage that we hear so often with stocks. But let's go ahead and jump over to earnings beats before we talk any more about this. We did have a great session on Saturday. If you weren't able to listen, I'm assuming maybe Abby, if you're listening, you can correct me if I'm wrong, but I think we've probably got that recording over on YouTube, because it was a public webinar, or anyone was available, or anybody was invited to come in. So I'm assuming it's over at our YouTube channel, but if for some reason you can't find it, mail us at support@earningsbeats.com, and we'll make sure that you get a copy. But it was a webinar on Saturday talking about ETFs. We have a stock part of our service, but we also know that there's a lot of investors who would just much rather invest in ETFs rather than try and pick individual stocks. And so this session was really designed for those who are more interested in ETFs, but still incorporating a lot of the things that we do at Earnings Beats to evaluate relative strength, to look for the momentum, and then make sure you know what you own. That's always, anybody who's part of Earnings Beats or listens to me in the next, many weeks and months and years is going to hear this over and over again with ETFs. Know what you own. Don't just buy an ETF because it's doing well. Have a plan. It's not that hard. And we announced our ETF analyzer, which is a spreadsheet that we use and that we're going to have our members download if they wish, where you can basically put into the spreadsheet what percentage you want to put into which ETFs, and it'll automatically calculate how structured you are in terms of your sector allocation and compare it to the S&P 500. Because if you're involved in 5, 6, 8, 10 ETFs and you don't know what you own, it may turn out that you've got 61% in technology, even though the S&P 500 is 24%. Well, that's great when technology is doing well, but if technology takes a short-term hit, your ETFs are going to get crushed if your allocation's like that and you don't realize it. So, and then if you don't know it and you just think, oh, I've got bad ETFs, these aren't very good ETFs. And of course you sell them, about the time you sell them, they start to rise back up again, the whole routine there. But anyway, check that video out over at YouTube. And again, if you can't find it over there, then write us at support@earningsbeats. We'll make sure we get that to you. As far as action on Friday, I mean, our portfolios did really well. It was a mixed bag, and I'll get into the numbers here in just a minute on the market, but our portfolios did really well, and we're sitting at all-time highs. I continue just to be amazed. I mean, I've been amazed at the model portfolio for over 2 years. Even though I believed in the strategy that we were using, I just never thought in a million years that it would perform and outperform the S&P 500 the way it has. But the strong AD portfolio, believe it or not, I think has been even stronger. This portfolio, we just started this in May of 2020. And I know, we're coming out of the pandemic and the market has been strong, but it wasn't an easy call to make to get into the market back in May. I mean, not with all the headline news that we were seeing. Many folks were thinking, okay, that was the start of, the Great Depression 2.0, and we were going to be in for it, later in 2020. So just making the call to put the money to work was a difficult enough decision. But this strong AD portfolio since then has been up 88% in less than 8 months. I mean, just let that sink in for a minute. And, get emails sometimes and say, well, I just don't want to take that kind of risk. These portfolios, the Sharpe ratio on them, it doesn't tell you that they're not risky. What it tells you, the Sharpe ratio basically tells you if it's worth taking the risk. Okay. So a Sharpe ratio on any kind of portfolio or mutual fund or whatever, a Sharpe ratio of 2 or 3 is outstanding. 1 is kind of average. 2 is pretty good. 3 is really, really good. That's like outstanding. And then just about any money manager would tell you if they could get their hands on a portfolio or something that's got a Sharpe ratio of 3, they would take it in a heartbeat. Our model portfolio, last 2 years, our Sharpe ratio has been almost 10. So I'm not going to say that the model portfolio goes up no matter what. It goes down when the market goes down. But because it's invested in 10 equal weighted leaders, those leaders tend to get that money the quickest when the market bounces back. And so the history of the model portfolio to date has been that it goes down with the market, but then it outperforms on the way back up. Again, there's no way I can say, hey, that we're going to match the next 2 years what we did the last 2 years. I wish I could say that. Quite honestly, if I knew the S&P 500 was going up 42% the next 2 years, I'd be happy if we were up 50%. Forget about 225%. 50%. I mean, just beating the S&P 500, that's really our goal. But anyway, these numbers have been pretty outstanding. And, think about it like this. If you think, okay, well, I think if your thought process is 10 stocks, equal weighted is too risky, then maybe if you've got a portfolio and you've got a portion of your portfolio that you want to be risky with, think of it as that and just take that portion and consider either our portfolios or stocks from our strong earnings chart list, because that's where all of these, well, with the exception of a couple in the strong AD portfolio, that's basically where these stocks come from. That's our flagship, our strong earnings chart list. Companies have to beat Wall Street estimates, revenue and earnings per share to get on that list. So it's pretty important. Anyhow, I could go on all day about this. But if you would like to just learn a little bit more about us at Earnings Beats, I would highly recommend that you just sign up for our free Earnings Beats Digest newsletter. Comes out 3 times a week, Mondays, Wednesdays, Fridays. A lot of different topics. This morning, I wrote about a stock that maybe it's bottoming. And if you know me well, I don't talk about bottoming stocks very often. I'm looking for breakouts. I'm looking for momentum. I'm looking for leadership. But I looked at a stock and I was like, okay, well, this one might be starting to turn. Very well-known company. And so I just gave you my perspective. If I was to look for a stock that's bottoming, these are a few things that I'd be looking for. And it's not to say it's going to bottom. And believe me, I would have stops in play. If you're going to trade any stocks on the way down that are underperforming the market, if you did take a chance, just make sure you have a line in the sand and you're not going to risk too much. Because these stocks, when they are underperforming, they can underperform for a long time. But anyhow, if you type in your name, email address here, hit the subscribe button, we'll get you added to the list. There's no credit card required. I'm telling you, it's completely free, and you may unsubscribe at any time. If you unsubscribe, you're not going to hurt my feelings. It might be something that's just not for you, which I completely understand. But I think for the majority of you, it's either going to be educational or it's going to help you in your trading or investing in some way. So it's just one thing that we do to give back to our community. So check that out if you haven't already. All right, let's take a look at the market action on Friday, because it was a little bifurcated. We had the Dow Jones actually finished up slightly. S&P 500 was up 0.5%. NASDAQ was up 1%, but small and mid-cap stocks were down. So, and you can see these groups have been absolutely on fire of late, moving up really the last couple of months. I think the virus news really helped to spur mid-caps and small caps, although they were outperforming the S&P 500 even before that. But they've been moving up at a really nice rate in record high territory, along with all the other major indices. Things look pretty good here. Discretionary, I'm going to talk about discretionary a little bit in just a couple minutes. But discretionary stocks led on Friday, went up more than 2%. Real estate also had a nice day, bouncing off this area of gap support. Now we need to see if we can get back through those moving averages. Then you've got materials, kind of on the flip side, down almost 0.5%. I'm not a huge fan of materials, but they're holding up right now, and I'm going to tell you why I'm not a huge fan of materials in a minute as well. Autos, another big day, and I can't tell you how many times I get emails about, should I get out of Tesla, or should I get out of NIO, and because these stocks are in our portfolios and have just been absolutely on fire. And I think it comes down to whether you're a trader or if you're more of an investor, because our portfolios are designed to hold for 90 days. No exceptions. So some don't understand when stocks are going down, why don't we have stops in? Well, we're trying to make these simplistic, transparent. We want to be disciplined. They're really designed for folks who want to take advantage of relative strength and momentum, but don't have the time nor the inclination to watch the stock market every day like I do. And the results speak for themselves. I mean, go back and look at our portfolio results. I mean, why would I want to change anything? But I've seen stocks that have broken down in our portfolios, and we used to do stops, and we got stopped out, and they were leaders, and the stocks came right back up. And in every case where we got stopped out, we'd have been better off holding. And then, of course, when we started holding was when the pandemic hit. So we held a bunch of stocks back in February and March, and maybe even into early April. But those stocks came roaring back. And that's what's really making me more and more and more optimistic about these portfolios and the strategy of being in leaders. Because when the market comes back, that's where the money seems to immediately rotate back to, those leaders. So when I look at autos, and I look at Tesla, and I look at NIO, you could have looked back a month and a half ago, and you could have said they can't go up any higher. You could have looked back into, the autos back into August and said, that they just can't, almost at 500, can't go any higher. Well, now we're 4 months later, 5 months later, whatever, we're over 1,000. I don't know where we're going to be in a month or 3 months or 6 months. I believe we're in a bull market, and I believe these stocks are growing their earnings rapidly, which is why Wall Street's gravitating toward them. But I couldn't tell you whether the auto index is going to be at 1,400 in 3 months, 1,800, 800. I mean, the group certainly deserves a pullback. I mean, it deserves something like we saw back in September. Maybe we'll get it, but I think at a minimum, I would be fine as long as this group continues to trade above its 20-day moving average. I don't see anything negative here. On the negative side, though, we did see the mining stocks not do well on Friday. So gold mining and just mining in general was down. This was the worst performing. Actually, I think paper might have been worse, but paper is generally influenced by just a couple of companies. So I thought this was a more important one to show because I am going to talk a little bit about the dollar and the reason why I'm not a big fan of gold going forward and the miners. All right, let's keep moving. 10-year Treasury yield. Let me give you an update here. Make sure I got the latest. 1.115%. We are up 1 basis point. So we are continuing to see a little bit of selling in the Treasury market, which is driving the yield higher. There's no real economic reports of any substance that I saw due out today. So I don't think the market's going to be reacting to anything economically. Yeah, I'm trying to think. I thought there was one other thing I wanted to mention with the Treasury yield, but I can't think of it right now. I mean, I would say at this point, watch 1% of the downside. I think psychologically now, maybe a little bit below because we had these highs just below 1. But I think 1% is going to be a psychological support level to the downside now. You've got that rising 20-day moving average, which has been pretty good support the last few months. That's up at 0.98% right now. So that should produce some pretty good support for the yield down around that level. Now, technically, you don't buy and sell the yield, you buy and sell treasuries. So when I talk about support on the yield, it's really resistance on the treasuries that we want to kind of watch. Okay, let's move on to talking technically. And I mentioned some of this in the event that we had on Saturday, but it certainly bears repeating. If you weren't at the event, it's something that you need to be aware of. One of the things that drives the stock market is the relationship between consumer discretionary and consumer staples. And if you don't believe me, you don't have to take my word for it. Look at the correlation down here, last 10 years. The correlation between the direction of this ratio of consumer discretionary versus consumer staples. The direction of that ratio is positively correlated most of the time with the direction of the S&P 500. So if consumer discretionary stocks are outperforming consumer staples, chances are we've got a strong S&P 500. And it makes sense to me. Some things, you listen to some technicians and they say, well, if this line goes up and this line crosses that line, well, you got to watch for this other line. But they don't explain anything and you're just watching lines. And it's like, this doesn't make any sense to me. Well, I'm going to put, my retirement account to work based on whether this line crosses that line. That doesn't make any sense. What does make sense to me, though, is that consumer discretionary, they're stocks that sell us the things that we want. And when we're willing to spend the money, those stocks can grow their earnings very rapidly. Consumer staples, on the other hand, sell us the things we need, and their earnings are much more stable. You're not going to decide whether or not you're going to brush your teeth based on how many jobs were reported last month, or what the economy is doing. Hopefully, you're still going to brush your teeth every day, maybe a couple times a day, depending on your own personal hygiene. But please brush your teeth. With consumer discretionary stocks, if the economy gets weak and you start feeling it in your pocketbook, you may not go out and buy that Peloton, or you might not go out and get your Starbucks latte, or you might not think about upgrading that house and moving to another home. Those are the consumer discretionary type items that get impacted by the economy. Brushing your teeth and buying soap and things like that, hopefully, does not get impacted by those things. So it just makes sense that when you've got this ratio going higher, it's telling you something that's very good and very bullish about the market and what the market sees going forward. So watch this ratio and look at what it's doing right now. This is important. Forget about what they talk about on CNBC. This is the stuff you need to be focusing on, and that never gets talked about on CNBC. If it does, please send me an email. I'd really like to know, because this is why I stopped watching CNBC and many outlets, media outlets, because they don't talk about the things that are important. They don't educate the public. They scare the public to get them to read their articles. But anyway, I could keep ranting about that, but I'll stop there. Next up, another thing I talked about, because back in the fall, even in the summer, when I was talking about we're in a secular bull market, we're going to go higher, there were so many emails that I would get, and they're like, what could drive this market higher? We got a pandemic, jobs, it's going to be a while before jobs come back. We're waiting on a vaccine. the list just went on and on. Why? What could possibly drive this market higher? And I talked about two things specifically. One was the transports. And if you study the stock market, when the transports are rising, the S&P 500 does very well. And this chart just shows you. I'm not making any of this stuff up. I've got a chart up here of 12 years. S&P 500. Look at it when it goes, or this is the transports. These directional lines. This is when transports are trending higher. Look at what the S&P 500 does. When the transports are struggling, look at what the S&P 500 does. You get a lot more volatility. Up, down, but basically sideways. Look at what we're doing right now in terms of the S&P 500 and the transports. They're both going up. We continue to break higher. So I think this is really important. The other thing that I think is important is the Treasury yield. When the Treasury yield's rising, money's coming out of Treasuries. That's really important to understand that relationship. That isn't just sometimes. If I pulled up a correlation between the Treasury yield and Treasury prices, it would be exactly at +1 all the time. Or excuse me, -1 all the time, because they're always going opposite one another, perfectly inverse. So when the yield's going up, means money's coming out. Folks are selling Treasuries. Well, if you've got folks selling billions of dollars worth of Treasuries, they're getting proceeds. Now, unless they're just going to sit on cash, where do you think that money is going? Well, it's going into the stock market. And this is kind of an indication of how it works. When the yield goes up, the stocks go up. I mean, if you look at these blue shaded areas, when the yield goes down, now this is the difference between a secular bull market and a secular bear market. In a secular bear market, if you go back in 2000 to 2010 and look at the yield going down, that means money's going into Treasuries. It's coming out of the stocks, out of the stock market. In a secular bull market, we just tend to go sideways. We do more consolidating when the yield is dropping, not necessarily major moves down. I mean, we did have the pandemic, obviously, but that was kind of a one-off kind of thing that just scared everybody, for those couple of months until we started to bottom, or really for maybe 4 weeks or so. But anyway, the point is, when the yield is rising, which we're rising right now, money's coming out of Treasuries. That money needs to go somewhere, and it's going into stocks. So while this yield is moving up, don't get bearish. That's telling us there's more money available to go into the stock market. All right, let's keep moving here. I want to talk a little bit about the dollar and why I believe the dollar is going higher. And again, this is another chart that you've probably seen before if you follow earnings beats. But all I do, I found this correlation that seems to work really well, where when we compare the U.S. 10-year Treasury yield with the German 10-year Treasury yield and take the difference, not the ratio, but the difference. So if the U.S. yield is 1%, the German yield is 0.5%, then the difference will be 0.5%. Okay. It's not a ratio. It's not 2 to 1. That's not what I'm doing. So this difference, though, as the yield moves up faster in the US, or if the yield is moving down faster in Germany, either way, this will go up. So anytime that this goes up, if you notice, the dollar tends to go up, which makes sense. Because if the U.S. stock market, or if our economy in the U.S. is strengthening faster than Germany's, money should rotate out of bonds and into stocks faster, at a faster rate in the U.S. That's kind of the correlation that we look for. So as this ratio goes up, or excuse me, not the ratio, the difference, as this difference goes up between the U.S. Treasury yield and Germany, typically we see the dollar index go up. And if, again, don't believe me, look at the correlation. It's almost always positive, many times above 0.5. If you look down here, 0.5 to the downside is an exception. Here, it's like the norm up. So my first point is that when you look at the overall move here to the upside and look at the dollar, don't look at the individual periods, just kind of look at the charts. We're going up on both. So you can kind of get that sense of the positive correlation. Now, we do go into periods where we see the opposite for a while, and that's what these shaded areas are doing. So here's a green shaded area where the difference in our yields, US versus Germany, US is the yields are moving up faster, but the dollar is going down. US is going up faster in yields, dollars going down. US going up faster in yields, dollars going down. In each of those cases, look at the inverse correlation that develops. And in each of those cases, look what happens afterwards to the dollar. The dollar comes roaring back in all three cases. And then we go positive again with the correlation. So this, to me, was a pretty good signal that you couldn't trust the dollar going lower, that we should be expecting the dollar to rise. And that's what we saw in each of these three cases. Now, in 2019 and into 2020, we saw the opposite. That's red shaded, where the yields were going down more in the US than in Germany, yet the dollar was setting new highs. And there's your inverse correlation. But what happened? The dollar played catch up again. It was the dollar that was playing catch up, which it turned lower as a result of the yields in the US going lower. Now, I want you to look at what's going on right now, because over the past 5 months or so, maybe 6 months, we have been seeing the dollar, or excuse me, the yield in the US rising pretty rapidly versus Germany. And yet the dollar keeps going lower. And you keep reading, I keep reading all these articles talking about how gold, you gotta be in gold. You gotta be in gold. I saw an article this weekend, gold's near its all-time high, which, hey, in, just the headline is fairly accurate. Gold is not far from an all-time high. But if you want to look at gold as a investment versus the S&P 500, gold on a relative basis has been horrible, absolutely horrible. So you look at this and I see the dollar probably going to move higher unless it's different than these last four inverse correlations that we've seen. Maybe this time the yield comes back down, but in every case so far, it's been the dollar that reacts and moves back up. So I think we're going to see what we saw before and the dollar move back to the upside. And if that happens, I wouldn't want to be in gold. I mean, here is a chart of gold relative to the S&P 500. Now, look at what happened back in 2000 to 2008, 2009, even all the way to 2011. The US dollar was going down. Gold on a relative basis to the S&P was going up. Since 2011, the dollar has been going up. And the performance of gold and the performance of the CRB index, which is commodities, relative to the S&P has been going down. Look at gold over the last 9 months relative to the S&P 500. Yes, it had a pop. When we had all that fear, the pandemic, absolutely money was pouring into gold. But since March, since the peak of the volatility, gold has been underperforming, and it is at a 9-month low right now. Now, you tell me that headline talking about gold being at all-time high isn't misleading. That's what frustrates me about the media and this is someone who does this stuff for a living that I'm reading. And I'm just shaking my head thinking, how many people are you getting to pour their money into gold right now, which is literally like, for the most part, since 2011, you might as well, on a relative basis, just go out and, find a gutter out front and just put your money in it. I mean, it's been horrible for 9 years. I don't think it's time yet. And when I saw this, the dollar break down, one thing I've been saying is watch this support area around 88.5 to 89. If the dollar index breaks that, we need to reevaluate. But if it holds, because that was a big area of resistance here, and now it's a big area of support, that's where I would expect we're going to get this bounce if we get down that far. And again, based on what this other chart was telling me, it's probably going to be happening fairly soon in 2021. I'm not saying, today, tomorrow, next week, whatever, but I think it's going to be happening really soon. All right, let's pull up a couple of earnings here, and we're going to kind of combine the earnings with the 3 you must see. So this will be the first 3 you must see stock. Commercial Metals, they reported earnings this morning, 58 cents versus 57 cents. Stock was down pre-market 1%. looks pretty good here. Although when you look at it relative to the steel index, it had been downtrending for several months. So I see a mixed picture here. If I was in this stock and the stock's down with a better than expected earnings number, I would maybe just watch that 20-day moving average. If it trades back down below it, we got a breakout. So if we pull back, that would be okay. Again, there's a lot of stocks I like better than this one, but that's where I would kind of look for as a line in the sand would be the 20-day. I mean, look at the AD line. That's not very good. Relative strength has not been good. There's a lot of reasons why I'd want to stay away from the stock. But again, if it's something that I took a position in, just make sure you keep your stop tight. The second stock that came out with earnings this morning is AZZ. And by the way, the real kickoff to earnings season, in my opinion, is this Friday. That's when we have JP Morgan, Citigroup, Bank of America, PNC, Wells Fargo, some 4 or 5, 6 big money center banks. And that's when, to me, that's what kicks earnings season off. AZZ, now we are seeing better relative strength here. Stock, market just opened, so the stock is down just a little bit here. But the AD line, strong. Relative strength has been, pretty good. So even though we're down here a little bit, I would watch that rising 20-day. I think that probably holds on any weakness. If it does go below the 20 and you're watching it, see if it comes back up and closes above the 20 at the end of the day or later this afternoon. That would be a pretty good sign. I like stocks that are uptrending that go below the 20-day intraday and then come back up and hold it. It's almost like it's a false breakdown. And many times that can trigger some buying. So that's the second of the 3 you must see. And then if it gives me a stock here, I'm just going to randomly pick out the best performer in the S&P 500. And we'll just pull it up. Wow, Lilly. Okay, Lilly, big move. I didn't see news on Lilly today, so I have to go back and take a look. Maybe some drug news. But anyway, stock, big breakout here. Lilly's been showing relative strength, and it's continuing here. Now, I don't like chasing a gap up at the open because you really don't know which way it's going to go. You have to always keep in mind that when everybody wants to buy, market makers are selling. So the path of least resistance on any gap to the upside is back to the downside. And so that's my initial thought, is that when a stock gaps up, it's going to move lower. When it keeps going higher, that's when it tells you there is a ton of demand out there. Because if market makers are taking the short position and there's so much demand that the market makers have to cover, that is usually a good sign that the market believes that that particular stock is going to go higher. So the only thing I would say here with Lilly is it's gapped up. My guess is, and it's a guess mostly based on experience and history, but the majority of stocks, when they make a gap like this, tend to move lower. So I would expect that this stock's going to come back down, but we'll see as the day progresses. Again, if it doesn't and it turns back around and goes to the upside and you get a big hollow candle, that's bullish. And today's open would become a very big price support level. So keep that in mind. But that's why I don't like to trade when a stock first gaps. I like to see what it does to get a better sense of where I think it's going. All right, that's it for today. I'll be back tomorrow over at Stock Charts for a recorded version of Trading Places Live. That'll start at 9 a.m. Eastern. So go over to Stock Charts TV and check that out. In the meantime, everybody have a great day, and be back tomorrow over at Stock Charts. Happy trading.